Good morning, everybody, and welcome to another Nacho Tuesday. And today I have Jordi here with Objective. And without further ado, we'd love if you could introduce yourself and your background, as well as your company.
All right, Jordi Pujol from Objective, obsessed with everything valuation, pricing, and how to get the value of pretty much anything.
Nice. Yeah. So tell us more about your background. How'd you become a part of Objective, and what are your goals over there, I guess?
Sure. So it's funny. I've always been kind of obsessed with understanding the value of things, right? Like, why is a diamond that is just like this tiny, shiny rock worth so much? And at the same time, why are certain shares of companies worth so much, whereas other companies kind of don't seem to get the same attention? And to me, at the end of the game, it's all about cash flow, right? It's all about dollars and cents. And so if something's pushing out the cash flow, it should be worth just as much as something else, even if it's in AI and tech, right? So I got obsessed with that early on. College economics, master's in finance, MBA in entrepreneurship. And this kind of world really made sense to me at Objective, of helping early stage entrepreneurs, middle stage founders, and family-owned businesses do their valuation, stay compliant, and get a better understanding of how to make decisions that are value-based. So that's what I do at Objective, and that's kind of what the company does. We also sell companies, but my role is primarily on the financial modeling side.
Nice. And tell us about some of the companies maybe that you've worked with in the past. Do you have any interesting stories? You don't have to name names of the companies.
Yeah, I was going to say, I don't want to for public knowledge, but
I think we have some contracts that cover that stuff.
Our other partner, Channy, he always have a fun story that he's like, yeah, sometimes I'm working with like two guys in a garage and a dog, and sometimes I'm working with companies worth $1 billion. And honestly, that's kind of the range of companies that I work with. I'm about to turn in the valuation of a company. It's literally basically $1 billion on the valuation. And then I'm also working with some very early stage entrepreneurs that are, just trying to figure out how to do very unique engines. So I specialize in that kind of technology space, biotech, all the way to kind of like beverage technology. And I've been in this world for almost 5 years now. But before that, I was at Ernst & Young, and I worked with a lot of asset managers. And so even though we were doing, $20 billion transactions on one end and valuing assets and IP, we were also doing a lot of work with the asset managers and the portfolio companies. So that's kind of the world that I like: high growth, SaaS, biotechnology, life sciences, medtech, all of the fun, unique stuff that you get to see.
Yeah, you might see more of those AI companies, those two-man shops coming up that have $1 billion valuation here pretty soon.
I just did a valuation of another company, and I think they just got $100 million funding, and I think it's a team of 7 people. So that's pretty wild, right? Like, that somebody can use a team of maybe 4 or 5 engineers plus a couple of salespeople or managers, and together they can form $1 billion company. Like, that's the world I want to live in. I said it in a different podcast, but when you have a single person running a company, and it's just one person doing about $1 billion, that's a fun world. That means a lot of people have a lot of opportunity to learn about AI and leverage their knowledge and their talent to get to wild valuations, and it's exciting.
Yeah. So invariably, when they do get a term sheet put in front of them, what are the numbers? What do the numbers actually mean, I guess, for them? For a lot of these founders might be engineers, great product guys, but they don't know the first thing about, raising money or the valuations behind it.
Yeah, absolutely. I mean, look, if you're already getting a term sheet, you're in a good spot, right? You've already succeeded beyond what many, many, many companies are doing. So that's pretty exciting. Pat yourself on the back. And now the numbers, right? So people get really stuck on the headline value. They want a certain number. No, we want to be worth $5 million, or we want to be worth $10 million or $100 million, right? And that's great, right? Like, if you want the headlines to show that and you want that to be part of your press, certain numbers, trigger certain feelings on people. Like 10 million is a nice threshold to cross. But what you really want to be thinking in your term sheet is, what am I giving up, right? So not only what am I giving up, that it feels like I'm giving up, right? But what am I actually giving up? So what does that mean? Analyzing, let's call it 3 scenarios. 1, your ultimate upside, right? So based on this round, what does it look like on the ultimate upside, and how much of the company did I share? Because if for whatever reason that upside, suddenly you shared 45% of your company, that's not a great outcome, right? Like, you shared too much at the beginning. Yeah. If you have some middle ground sharing where actually you don't make any money because the VC protected themselves so much, that's also not a great outcome, right? Because even though you're shooting for that $1 billion IPO, you might get stuck in $100 million M&A, which again, very successful event, but you may not reap the economics because the VCs protected themselves so much on participation, on liquidation preference, and a bunch of other things. And then the downside scenarios, right? You don't want to work for a company that doesn't succeed, and somehow you're in a worse place than when you started, right? You want to protect the VC in those scenarios, but you never want to be left with owing money or something like that, right? So when you're dealing with notes, make sure that there's no like cash redemption options. There's no way for them to bankrupt you if they have certain rights. So I say that the rights and preferences of the raise are just as important or more important than the headline value. And then number two is make sure that you're sharing the piece of the pie that you want to share for that stage, right? Because some people get really stingy. They're like, no, I only want to share 10%, but then it's not really going to be worth it for the VC giving you $1 million, right? They want 20, 25%. They want a big chunk because they are going to get diluted in the future. And so you want to make sure that the incentives are aligned on both sides, right? That somebody's putting money and getting a nice chunk, but that you're not overdoing it and losing, 45% of your company on certain scenarios.
Yeah, I guess, is there any downsides to having too high of a valuation when you're coming in? Obviously, investors might see the return on investment to be a little bit lower than what they had hoped for, but there could be potential downsides to future rounds if you're not able to meet your metrics and need to raise money in the future.
Yeah, that's right. You don't want to set goals for yourself that are way too lofty, and then that it seems that you were kind of this shining object that just became a dud, right? You want to be realistic about the valuation, and then you want to incentivize the next investors as well, right? So if they're going to come in at a down round, it already looks a little bit odd. Like nobody loves that, right? Where you were like, oh, okay, we got $100 million valuation at first, but it was all potential. And now that people are seeing the reality of how hard this business is, they want to come in at a $50 million valuation. That already puts stress in the mix that you don't really need. And when you're that early, again, it's not like you're going to realize 100 million that quickly anyways, right? These are paper valuations. They're hypothetical valuations on many things going well. And so you don't want to overdo it, right? You want to focus on how much money do I need and how much of the pie do I want to give up at this stage? And those are the two primary factors that you need to think about, right?
Yep.
Not, am I worth 10 million, 5 million, 15 million? It's almost irrelevant if you're going to go through 3 more rounds of financing.
Yeah. Great point. I always tell founders, you won't be complaining about it on a beach, after you sell your company in the future, about a couple percentage points. It's all about momentum, right? Early stage, you really got to get that money in the door. You got to build your product out, get product market fit. Hopefully you even have it before you raise money. This ain't 2022 anymore, I guess, but
yeah, exactly. With the AI companies, people are still funding based on ideas. Yep. I heard a really fun quote the other day that it's like, almost every company is a wrapper of something else, right? And so people are really coming down on some of the companies that are just wrappers of Claude, just wrappers of ChatGPT. Yep. But if you create a visual system or a UI or some type of company that relies on these algorithms in the background, but you didn't have to spend billions of dollars to come up with them, you're just using their systems, but your wrapper is fantastic, right, for a particular niche, you can be worth a lot of money too, right? And again, could somebody come in and then do it themselves? Yes, but the odds are against you, right? It's like AWS suddenly deciding to do Prime Video. Sure, they were competing with Netflix, but Netflix has the advantage there. And the same with AI, right? If you're the preferred provider for that particular niche service, you're still gonna grow. You're still gonna be worth a lot of money. And as a raise, as a funder, as someone looking for funds. Again, you just want to go step by step and carry that momentum forward, like you said.
Yep. I guess what kind of moats do you think founders could really establish in the early days? I feel like community is a big one these days. Being an infrastructure play, like something people can't live without once you get embedded into their systems. Like there's this new program called Victor that we put into our Slack, and we just got used to using this guy. So they're definitely doing a land and expand strategy, which is brilliant. But now that we got so used to using this AI workspace tool, the time for upgrading came, and of course we're going to do it. What are the tips you have for founders?
I mean, that's a great model, right? Like the freemium model where you have a free version and people upgrade. I think it works really, really well, right? Everybody wants a product that they can try, they can like, and that other people are using, right? The network effects are really important. And now more than ever, you can reach a lot of people really quickly.
Yep.
And it's a test in it of itself, right? If you've already been able to penetrate the Reddits and penetrate the Discords and penetrate the Slacks of companies, you're showcasing that there's virality in your product, that people want to use it, and that there is some product fit, right? Maybe not product market fit, because you still have to figure out the economics and the business side of things, but you can already raise a lot of money by showcasing that, hey, in a couple of weeks we went from 100 users to 1,000 users to 10,000 users. That's huge, right? That's a 10x curve that you're seeing that can get exponential. And is it obvious that people are going to pay for it? Not necessarily, right? Again, there could be a lot of competition. There could be somebody else with the free side. But if you're already showing traction, it can be in terms of sales, it can be in terms of usage, it can be in terms of downloads, it can be in terms of people buzzing and talking about it, like Claudebot. Those are all really, really important things. Now, VCs, and hopefully, later we'll talk to some real VCs that are putting money out there. But what I'm hearing on the side, where I'm seeing at pitch competitions, what I see with the actual financings is that people more than ever want experience, traction, and some vision of the future economics. If you don't already have them, a lot of people are already requiring economics, right? Meaning you already sold product, people are buying it, you already have subscriptions. People are already wanting that at like a Series A, right? Which, like you said, in 22, maybe people were like, well, we'll just fund the idea and go from there. But I give another kind of like simple metaphor that if you're hiring someone to cook for you, you want to know that they've cooked before, right?
Yeah.
Especially if they're making a really complicated dish. Okay, if they're grilling some meat, well, we'll trust them and see what happens. But if they're doing a really complicated dish, you want to know that they've been there, that they've done it, that they've practiced. And so it's not that you can't be a 17-year-old founder, but hopefully your story, if you're founding a company at 17, is, hey, I started coding when I was 10 years old. I loved it. I used to do fun apps with my friends. I have a team of 4 or 5 friends that we've been, coding together for a long time. I'm part of these Discords. I'm part of these Reddits. I'm part of all these communities, right? That's someone that's interesting, right? It's someone that's in the mix, someone that understands. Hey, I used to love to go to pitch competitions for fun, and so I understand these things. I have a friend who's gonna start doing business in college, and so he's part of the mix, right? All those things kind of, they don't sound as great, right? Because it's still very young and very inexperienced in a way. But they're things that help people feel comfortable with funding. Now, it gets even better, right? People that have worked in the industry, that have the networks, that have the industry connections, that understand who are the buyers, who are the people in companies that you need to reach out to, who could be your potential targets. Suddenly that person becomes very helpful to a company, right? And so if you now gather a team and they're all full-time and they're ready to go and they're like, this is the moment, this is a critical point in time, and this is why my team is uniquely positioned, and this is our unfair advantage. All those things start adding up, and somebody trusting you more and more with a lot of money, right? At the end of the game, it's a lot of money that someone is giving you to go and try out an idea. They want to just make sure that they're de-risking at as many points as possible.
Yeah, you touched on an interesting point there. There's a panel taking place at South by Southwest. One of our partners is putting it together. It's about creative founders, essentially. So how founders are becoming creators. So do you feel like that's a really compelling strategy these days? Like, you have to be out there in the community. You have to be in these forums. You have to be, producing content, sharing your vision and connecting with other people in the community to really be successful.
100%. I mean, one, it's free, right? So if you're ever going to try an ad, first try it on the free versions, right? If your videos and your ads and your content is not really going that viral, probably means you shouldn't be putting $1 million behind it anyways. So they're test grounds. They're ways to do it. But, I'll sometimes be scrolling and just look at this product, right? Like some new version of gum, new version of gummy bears, whatever. Right? All of these things are getting virality. Why not on the software side, right? Why not on user software that that people want to see somebody else use, and then they're like, oh, maybe I'll try it myself, right? And it can be kitschy and it can be fun and it can be ridiculous. I think as long as you're getting the eyeballs, that's a great start. And then you have to think about conversions, right? So it's all kind of like fun and tryouts and testing. That all that part can be very creative and unique, but then you got to get a little bit more professionalized and try to think, okay, like where am I converting, right? Am I driving people to my website? Am I driving people to downloads? Am I driving people to usage and tryouts? Because if you're not, then it's really just more content. It's for entertainment purposes. Yep. But these platforms allow you to track all these things. And so you might as well, like I said, professionalize that second stage where you've already tried some things. It's hitting with the audience. You're building community. People like you. Okay, now let's try to convert them to actual users and even further into actual paying users.
Yep. Yeah, that's a great point too. I feel like a lot of people are starting to buy the people behind the brand more than ever. So there's, obviously having a great product, but just being known in the community and having that level of authenticity, I think is really big these days. And a lot of the top performing founders I see really are just, they're out there, everybody knows them and kind of gets behind their company. So like once they launch something, they kind of have a movement already behind them.
Absolutely. I mean, you want to know the people behind things, right? And you want to know that they have a good mission. Someone's telling their story and they're creative and they have a unique angle. People get behind that, right? And again, it's all about recognition at first, about building trust, especially. And if I like the founder, I'm like, oh, okay, right. He's building, this physical bot that is supposed to help you taking notes on the side. And I hear the story and I hear some people using it. All of that gets me excited about the product. And then I'll tell a friend, right? Or I'll share the video. Yeah. And that's how it starts. I mean, people are talking a lot about personal branding right now. Yeah. And it's true, right? These micro influencers kind of show that people do care about stories. People do care about what other people are doing. And it's democratized, I think, a little bit of the media space, where you don't need 1 million followers now to make money. And that's exciting on its own right? Because it gives an opportunity for other companies to also reach out to these people, have them try their product. Hopefully they're happy about it and they post about it. But if they're not, again, it's a testing, right? If you send it out to 100 people and nobody posted about your new sweater or whatever it is, it's probably not that new of a sweater, not that unique.
Back to the drawing board.
Right, exactly. So, I think they're testing grounds, and that's the best possible thing that you can do. I used to have a professor that said any time that you can play tournaments, either with product or with your company or with anything that you're building, it helps you get better and better through the stages, right? So you compete, let's say you have 10 things that you're maybe thinking could work, 10 features, and then you realize, okay, out of these 10 features, these are the 5 best that everybody talked about. Okay, these were the 2 that actually people were using, and this is the one that clearly has virality potential. Just develop that feature, right? MVPs, maybe at the 10x level, but it sounds like people only really care about this one feature. That's fine. You can start there and then build from that core base that clearly had more traction than everything else you were doing.
Yep. It's way easier to start with, MVP. You start with a very simple that solves, the big problem and what people really want. Then you can start to layer on, premium features, stuff that people might want in addition to that. But really it just comes down to, are you solving the core problem?
Exactly. And before, right?
So I guess, yeah.
Oh, sorry. I was saying that before, without all these viral platforms, it was very difficult to do this testing, and it was very difficult to do this testing at scale, right? You had to spend a lot on ads, or you have to reach out to a lot of people through cold selling, and those things are difficult, right? Whereas now, again, you can kind of test it out in different ways, and if you see that excitement, if you see that momentum, then kind of double down on those areas.
Definitely. So, in terms of like valuations, like what are the metrics that VCs are looking for these days? Obviously, having a great product is one, some sort of level of traction. Maybe a founder that's out there that's got a good reputation behind them. I guess what other metrics would really drive that valuation up at an early stage that startups should focus on?
Sure. So a lot of people really appreciate traction from multiple angles, right? We always talk about stickiness as being one of the most important metrics. It used to be that if there were high barriers to entry or high barriers to exit, that was a protective moat. More and more products are not really having those, right? Everybody can kind of enter a space and compete in that space. And so it's really easy for people to switch products nowadays. At the same time, like you said, hey, this Victor is already embedded in our Slack. Everybody likes it. Nobody likes to switch. And when the status quo tells you we're on this product and now we're going to get 17 seats or however big your company is, that's huge, right? Showcasing that your users have been there for the last 2 years and they love the free version, then they upgraded, then they re-upped again. That traction on stickiness is extremely important, right? Because I know that every time I add someone, I'm going to be able to retain them for a while. Why is that important? Because CACs are really high these days, right? Trying to get a user is extremely expensive. It's time consuming. So you want to keep them for the longest time possible because that's how your long-term value increases, right? Typically, maybe even that first year might not be profitable, but year 2 might be where you start making money. And so again, you want to showcase that stickiness and you want to showcase those renewals. Another one is your ability to upsell, right? So if you are already, let's say, at 1,000 users and all the users are happy, but there's nothing else that you're offering them, what's the upside, right? I, again, have to just find the strategy where I'm acquiring new customers. But if I'm a company that shows, hey, I usually get them at the freemium, then we move into the $9.99 model in which they get these features. But 10% of those, move up to our premium tiers, and then they get these additional features. And that's the more corporate level, and that's the way we're going to attack the corporate world. Then again, you're showing that traction and that funnel so that people can visualize how you're going to upsell those customers, right? And if you already have those, right, 100 can be 10 on the upsell, can be 1 on the ultra upsell. That's fantastic as well. So that's another moat that if you can showcase, that's really great. Another one is your ability to continue to resell to the customers, right? So like if you're in M&A where you sell a company once and typically they don't come back, that's it. You kind of know that now you have to go and find new customers. If you're selling one-time items, right? Something like, I'm gonna, lifetime mattresses. How often do people change their mattress if they have a lifetime mattress forever? Right? When they leave and they have to sell it and then they have to buy a new one in the new city. But it's not really a product that will get a lot of kind of resales from the same client. That's not as good as the types of products that get recurring kind of revenue. So that's another thing that you can think about, the recurrence of that revenue. And then, sorry, go ahead. Yeah.
Oh, go ahead. Sorry.
No, and then a lot of the financial metrics start being really important at the unit economics level. Now we know that at other levels, you can be very efficient in the way you run a company, very efficient in the way that you outsource marketing, that you outsource sales, that you outsource even finance and accounting, right? You can run very lean companies. So people are really looking at that gross margin and are really looking at those unit economics. If you're not fulfilling the promise of gross margin and unit economics, you're already at a disadvantage to anybody else really showcasing wide margins. Software is one of those things, right? Where we know that it has really good gross margins once you've invested in it. And because now we can code faster, we can do MVPs faster, we can try out things faster, then the development costs are also coming down, which are boosting those gross margins. That's why software is such a kind of like fun space to be, right? Because if you kind of crack the product and you have really good UI and you have a good backend and you have good security, you can really leverage the sales in the future.
Yeah, that's a great point too. But the CAC for getting the customers now is so high as well. So once you're at scale, you got that premium, you get that higher margin set, but getting your initial customers can be a little expensive sometimes, which wise, as we mentioned earlier, product-led growth initiatives, finding that viral feature or go-to-market strategy could be really effective for your company. So like I mentioned, Victor, it's in our workspace, it's in a bunch of other people's workspace, and it has like a natural premium upsell that just works because you like the product, you know what it can do, you want more, right? So a lot of founders should look for those kind of viral type features and really, let the product in a way do the selling for you.
For sure, for sure. I mean, get product in people's hands, and there'll be your best feedback sources also. We've worked with startups that the way that they start is almost giving the product away for free to, let's say, private equities or investment banks, and we'll try it out with them. And the only thing that they ask for in return is that you're a feedback provider, right? Feedback is expensive, and people's time is expensive, especially for products in these kinds of worlds, right? When you're attacking private equity, these people are very busy, and lawyers the same way, right? But if they can get the product for free and it's a product that works and you know that it works, you can continually improve that product by having those free users. And it doesn't have to be 100 users either, right? It can be 10 to 20 users very early on. You take their feedback, you're working to make the product better, you're giving them what they really need, what they really want. Because as a founder, right, all you know is the ideas that you have in your head and the problems that you had. But if the more that you talk to people, you realize, oh, okay, maybe it was just me, right?
Yeah.
I was the one struggling with this particular thing. But it turns out that 10 out of the 20 lawyers that I talked to, they're all struggling with this other thing. Hey, maybe I should pivot a little bit. So customer feedback, incredibly, incredibly important. You'll probably hear from every single person that you talk to. Customer feedback is the key to success.
Yeah, it definitely is too. I always have the saying, love your customer like your product. So a lot of founders, really fall in love with their idea and the feature that they build, and they think everybody feels the same way, but they really don't. Whereas maybe sometimes they have like this thing, part of their product that everybody actually does want. And if you're listening
Mhm.
to customers and kind of seeing how they react to your product or use it, you could discover those nuggets and really determine like what areas of your business or product you want to focus on, and that's where you really get traction ultimately.
Oh, 100%. And it's fine to have strong conviction on something that people don't understand yet or
Yep.
don't want yet, but you got to get yourself to that future, right? And so if you have these kind of like cheat codes or these cheat avenues to sell them something that they just want now, okay,
Mhm.
work on that future in the background, right? Like don't lose the conviction, don't lose the idea. Even gigantic products like Uber and Airbnb, right? At some point, everyone was like, "Who's gonna just let some stranger sleep in their house? Who's gonna
Yeah.
just walk into a car of a random person that's not a taxi driver and do it, right?" But they had that conviction. At the
Yeah.
beginning, so they did try it, like the black cars, and people were more used to that. Okay, that's an entryway into people's psyche, and maybe they will try it, right? Or the Airbnb. Okay, people are familiar with B&Bs. Okay, so maybe we do bring someone and give them breakfast or whatever. And I think at some point they even decided to do cereals or something like that.
Yep.
But let's try it at conference. Let's try it at concerts, right, where people are younger, maybe more willing to stay at somebody's house, maybe sleep on their couch or whatever. And if people want that now, then you can work on the background of the future, and that's the
Yep.
best possible thing you can do, right? Stick to your conviction because it's contrarians and people who have wild ideas that ultimately make the biggest companies. But again, you got to get yourself there, right? So it's okay to do the simple things and the more mundane things that make you a little bit of money and give you a little bit of traction at the
Yep.
beginning.
Yeah, and what you're doing today might not be what your vision is for the future, right? But there
Right.
might be like a step-by-step strategy for how you get an initial traction in the market. It could be maybe you target like a really niche audience and you get your beachhead there. Maybe you figure out you have a positioning or product messaging problem. Maybe the product isn't good and you need to go back to the drawing board, right? But the more objective you can be to look at that and say, am I talking to the wrong people? Am I saying the wrong
Mhm.
things, or is my product bad? Then you go back and fix those things and get to where you're trying to go.
Absolutely. I mean, at the end of the game, there's probably a recipe now. Being an entrepreneur and doing startups is not a new thing. There are tons of recipes out there. Not everybody's recipe is the same, but you'll see that they have a lot of things in common. And so try to follow it, right? Try to stick to those points like we talked about: de-risking, building great teams, listening to your customer, building traction in so many ways, using all the testing avenues that are free that you have at your disposal. If you do those things, I can almost guarantee you that
Mhm.
you'll be successful, right? What's the problem? That like cooking, right? You have the recipe, but you open the book and you're like, oh my God, well, I didn't know I was going to burn myself. I didn't know I was going to spill the milk all over the
Yeah.
counter. I didn't know that the temperature of the oven isn't actually perfect, right? I decided 450 means 450, but you don't know that your oven has like hot spots and whatever, right? And so that's life. That's the reality of the world you're building in. But the recipe is there, right? Don't go too wild when you kind of know the playbook a little bit.
Yeah, you might have like your own little like variable or spice that you add to it, right?
Right.
But if you're making gumbo, you know, you got to have these ingredients, and then maybe your twist on it is that you add some sort of spice to it, right? So there's a common theme across all successful companies, is what you're saying, and then you know you just got to find maybe that one or two variable that really fits for your particular product or you as a founder, and you add that to the mix, and you get your own recipe from it. So
100%, right? And it's fine to add it, in the middle or even near the end. You don't have to add that spice at the beginning because somebody might just say like, hey, this is just not for us, right? Ice cream with chili crisp oil, that's not for us.
exactly.
but it works. It works. Yeah, exactly.
Yeah, like salty and sweet. People are really into that, but I'm not in
no,
particular. But a lot of people do like the salt and the sweet put together.
I love it. And at first, it seemed like a really odd thing to do, right? So I'm not going to build a restaurant entirely based on that when I know that may or may not work, but I can build a restaurant and have my star dessert be salt and sweet, right? Like that's perfect, right? Try it out, see what happens.
So I guess, how do M&A buyers evaluate businesses differently than VCs do?
All right. So we talked about the VC world, right? VC world is like 80% story, 20% de-risking factors, and then just a lot of excitement, right? The M&A world is completely different. And I just had a conversation with one of my M&A guys, and he was saying like, look, I can help you in this, but this is really VC world, and we're not as used to telling these like fantastical stories. We're really good and really used to telling the financial stories. And so M&A is all about financials, right? Does the company have a particular set of customers? Do their financials work? Now you're really looking at the entire P&L because you're going to have to adopt a team. You want to be looking at culture. You want to be looking at the way that they do things, timing, right? It becomes a lot more operational rather than story, right? So I can tell these fantastical things of like, well, this was the year that we were going to grow 50% because we're introducing these new things and we're going to be more efficient and this and that. But if you haven't done it in the last 5 years, the odds are that you're not going to do it. So no one's going to pay you a lot for the future. Now, M&A does fall in kind of two buckets, right? Sometimes I'm buying a company because I'm buying their growth and I'm buying their potential and I'm buying this new product that it would take me 2 years to develop. So that's kind of one world that actually looks somewhat like the VC world. And I can pay, 6 times on revenue, 10 times on revenue. Sometimes you see that. The other side is the more traditional side where I'm paying multiples that are related to profit. And I am looking at that future growth, right? And so if I have synergies with that company and I can upsell, cross-sell, add customers that are already on my side, I can add the sales force, I can add the channels, distribution, etc. Then I might pay them a premium, but I'm not going to share all my synergies, right? Because that company couldn't really have done it without us. And so you'll see multiples significantly below. They're typically being priced off of profitability, something like EBITDA, as opposed to revenue. And so ultimately, it's more of a financial decision that a company has to do. And you'll see it, right? When you're talking to their teams and you're understanding how they make decisions, a lot of the time they want to make sure that company is going to be accretive to the larger organization.
Yeah.
For the situations. Go ahead.
Okay. Yeah, I think you touched on a great point there. Like, how do founders, I guess, position their company in a way to make it seem more valuable to their M&A partner, potentially as a part of that process?
So for me, information cleanliness is extremely important. So if I'm buying a company and I'm a buyer and somebody comes and here's a financial package and I look at it and it's like, okay, great. Okay, let's dig a layer deeper. What are your top 10 customers? How much percentage of your revenue that they represent? And then they pull out another file and they're like, hey, here's our revenue by customer. And I'm like, okay, fantastic. Can you give me revenue by customer for the last 5 years? And they pull out another file, right? And I'm like, oh, okay, now I have revenue for all these customers for the last 5 years, right? So let's say I'm buying a service kind of based business. And then they tell me, we also have revenue by product, right? So you can tell exactly what services I'm selling. And I have it for the last 3 years as well. Wow. Like suddenly I realized that I'm buying a company that cared about structure, that cared about organization, that cared about information, and that they're an information-based decision maker. That's a fantastic way to make your company look better, right? Just having the information available, and as a manager, knowing the information and explaining how you made decisions based on that information. And now there are fantastic databases, there are great accounting systems. You can achieve all of this. It just takes time and effort to organize yourself. But if you're doing it, I would say that that's one of the single most important things that you can do before you sell your company.
Yeah, so keeping organized and then transparency, I think, is another thing you really hit on there. Just showing that you're an organized company. Actually, there's no hidden catches or gimmicks or problems that they're going to figure out later. At least they're coming into it with that sense of feeling. But the fact that you're transparent about the whole thing, that you don't have some hidden skeletons in the closet, so to speak.
Yeah, exactly. And it's funny. The other day, we went to look at an apartment. And it was like, hey, maybe this is a nice apartment. But you could see that the rug was kind of stained.
Yeah.
You could see that there was like a little bit of a water dot in the roof that maybe hadn't really been fixed. And then suddenly you start questioning, like, well, is the foundation fine? Like, is something else wrong that I can't see? Because I'm already seeing all these things they're odd, right? Like, why is this broken? Like, some of the light fixtures were broken, and we didn't really understand why you couldn't. Right, you're probably something wrong with the electrical, and maybe not. Maybe it was the light bulb that was off, but that already gets you antsy, right? In the same way, in a company where maybe it's just a light bulb that's off, but that's the person that you talked to, right? That was a particular manager that you spoke to, and that manager had no idea what was going on, couldn't really talk about the customers, didn't really understand the product or the mission of the company. That's a bad light bulb, right? And somebody can see it for what it is, or they can think that there's a deeper problem underneath.
That's a great analogy, actually, that I think a lot of people can relate to. You totally touched on a great point there. With that said, would love to, reintroduce Objective, and kind of, for anybody listening today, tell them about where they could hear more about your company, and what are some of the best companies that you guys look for to work with, and I guess what are 3 key takeaways or benefits of working with your company?
Yeah, absolutely. So we're an experience-based company. So everybody we hire typically has Big Four experience, big consulting experience, or has worked for other larger investment banks. We try to give a lot of senior attention to our clients. So typically, if they're working with someone, they're going to be working directly with me or some of the other managing directors. We're not kind of punting them off to younger folks that may be a little bit more inexperienced. So we really try to give that. And then all of our valuations, for example, I'm trying to provide additional insights, right? So some valuation companies will just hand you over a number, and there's not a lot of context of how you come up with the number. Can the number change? What affected the number? We make a huge effort to give people sensitivities to help people understand what are the drivers of value, to help people understand how they can improve that value, and what are some of the items that are holding back their value if, for example, it's not the value that they expected. So we try to provide value beyond just the number, and truly be a consultative kind of partner in their value building journey. So that's us. Like I said, I'm on the business valuation side. We also sell companies and prep them for sale. That's a longer process. Typically takes 9 to 18 months. And the idea is that you're working with the investment bankers on the full cycle M&A process to sell your companies, pitch them to the best possible buyers, and get the most value for what you've built.
That's great to hear. Yeah, and it's good to get this process started early. You don't want to be coming into it late. I mean, if you're talking valuation, if people are thinking about costs or anything associated with that, you're going to give up a lot more on the back end of your deal by not going about it in a professional way, frankly.
Yeah, absolutely. I mean, again, it's really hard to be critical of your own company. And so bringing a third party just brings an objective lens. There's a really famous professor that he says, the more I learn about a company, the less I'm good at valuing it. And I get it, right? Because you can get swayed by a lot of the well, but this company is unique because of this, or we're also doing this. But if I don't see it on the metrics, I don't see it on the financials, I don't see it on the way that the risk profiles are showing up, all that's going to happen, the more that I learn about the companies that are going to be more and more biased. So just imagine the person actually working in the company, right? They're 100% biased.
Yeah.
So that's what we say. Hey, bring in a third party, manage for value, figure out a way to lay stakes in the ground, and then look back and see what you're doing. What are you doing that actually is creating value? If you're just increasing revenue, but your margins are going down, you're probably not creating as much value as you think you are. And if maybe your revenue is flat, but you've been really working on your margins and efficiency and scalability, you're actually creating a ton of value, right? And you just don't know it. And so that's what we try to showcase to people, just help them understand where is the value, where can they harvest value that's already there, and how can they create future value.
Sounds like everybody needs an objective view when it comes to M&A.
That's why the name, exactly.
Yep. Makes more sense now. So where can people learn about your company? What's your website? Would you like to share it?
I'm great on LinkedIn. We try to post different things that make sense. For example, this webinar, obviously there'll be some clips and some other pieces of it on our website. But LinkedIn, website, and our blog, great places to find us. And there's a more small newsletter on LinkedIn also that I used to publish. There's some great content in there, but some future pieces are coming back as well.
Well, very excited to see the growth of your company, and excited about our partnership as well. Jordi, thanks so much for coming on today, and we look forward to doing more stuff with your company.
Absolutely. Thank you so much for having me.
Thank you, bud.